My name is Gonzalo Arias. I'm the International Cooperation and Taxation Director at the Inter-American Center of Tax Administration, together with Anarela Calderoni, who is an advisor in the International Taxation Management of the Inter-American Center of Tax Administration. We will share with you in approximately 40 minutes some ideas on how to improve the performance of tax administration in the control of transfer pricing in crisis times. I don't want to continue without thanks for your interest in this video, and to thanks especially to Pride Partners International for inviting CIAT to be part of this initiative. Next slide, please. As you know, transfer pricing practitioners from private and public sector knows that transfer pricing is perhaps the most complex tax issues. Historically, there are problems that developing and some developing countries can solve. For example, there is subjectivity and complexity of the analysis as a consequence of complex rules or transfer pricing rules. It generates lack of certainty. We know that big percentage of cases go to discuss or are being discussed in the court. There is lack of information, lack of knowledge on transfer pricing techniques or business or economic sectors. Tax administrations in developing countries don't have necessary human resources or financial resources, for example, to acquire a commercial database. There is lack of international cooperation. We saw a lot of advance or big advance in international cooperation all around the world, thanks to the Global Forum on Tax Transparency and Exchange of Information SHOP, but there is not experience in simultaneous tax audits, or, for example, in other tools that are complex to use, for example, country-by-country report, Action 13, Action 12 of the BEPS Action Plan on the disclosure of tax planning to identify risk, and other cooperation tools that could be useful to control transfer pricing. Other important topic is the low quality of the information or the analysis presented to the tax administration by some practitioners. It generates a bigger burden to tax administration because they have to offset different problems with the information, to apply fines, and it generates a bad relationship between tax administration and taxpayers, and a big tax burden for low results. And another important topic is that you know that transfer pricing, one of the transfer pricing objectives is to avoid double taxation. That's why transfer pricing is complex, or it's necessary to harmonize transfer pricing legislation all around the world with the OECD guidelines or standards. However, the tax treaty network in developing countries is not big, and sometimes when there are transfer pricing adjustments, the existing tax treaties are not used, and it generates double taxation despite the use of the arm's length principle and the OECD methods. Despite the importance of transfer pricing, because you know that transfer pricing involves relevant companies, high economic impact in the economy, because transactions of the multinational enterprises are very relevant for developing countries, it doesn't constitute a priority for some tax commissioners in developing countries. Why? You know that transfer pricing requires high administration cost for tax administrations. The direct collection, what is the direct collection? Is the collection that the tax administration obtain when they formulate adjustments is low in real terms. And the indirect collection is the voluntary compliance as a consequence of the risk perception by the taxpayer that see that the tax administration is controlling transfer pricing, is not calculated by country. So we don't know exactly why is the indirect effect of the transfer pricing control. It increases time, some challenges. What's the main indicator of the tax administration? To collect taxes. What happens if a tool is not useful to collect taxes? It's not a priority. So we need measures to demonstrate tax commissioners that transfer pricing is a good collection tool. In crisis times, it is necessary not to increase the existing taxes or to create new taxes for those who always comply. The idea is to reduce the tax gap when the tax gap is big, especially in corporative income tax. How is possible to transform transfer pricing in a good tool to collect taxes without affect business or violating the general principle that governs transfer pricing, the arm's length principle? First, more simplification or simplification as possible, more certainty, less litigation, and to assure better quality analysis of transfer pricing by practitioners to avoid bad consequences. But it sounds great, but how we can achieve the mentioned objectives in the low resources countries? First, we need to adapt good practices to each country. One size doesn't fit all, we know. To put more specific weight on planning than in control effort. We will talk about it in next slides. That is why we will present flexible ideas or proposals with different application alternatives to allocate tax base where the value is created. We can go now to the next slide, and I give the floor to Anarela Calderoni. Please, Anarela.
Okay, thank you, Gonzalo. Hello, everyone. So, in order to apply the best method rule, first of all, we have to look at the transfer pricing analysis from the beginning. And we know here that it's necessary to obtain extensive information from both the domestic and the foreign parts. The OECD guidelines tell us that the application of the correct method of the best method rule begins with analyzing the suitability of each of the 5 recommended transfer pricing methods, taking into account the transaction analyzed and the potential information that could be used to apply. So some challenges to doing this would be that sometimes we discard methods based on the administrative burden that is with it, or we discard methods because it's not easy to access the information needed from the foreign counterparty. Both of these reasons push us towards the use of unilateral methods. Other challenges would be that countries aren't exactly sure how to control operations that involve intangibles. And this problem is further complicated when we take into account that according to a CIAT analysis, out of 18 countries with transfer pricing rules, the option to use the foreign entity as a tested party is restricted in over half of these. So what can we do to better apply the OECD guidelines or to better arrive at the appropriate method? Well, one option would be to look at the diagram that's on the right side of the screen here. This one is to assist in the application of unilateral methods specifically. by simplifying the designation of the tested party, as we can see here, based on whether there are unique and valuable contributions or not. Another option would be to improve the understanding of the comparability analysis process. For example, by clarifying the definition and the process for how to conduct the comparability analysis in a way that distinguishes between valuable and non-valuable contributions. Also, it could be useful to have the legislation answer the questions that are proposed in the left side of the slide. Moreover, when we look at differences that arise between a comparison of valuable contributions or intangibles and the valuable contributions or intangibles and the comparable, we should try to eliminate these differences. One way to even see whether these differences exist is by looking at the common financial items that relate with the existence of intangibles. So, for example, advertising expenses, promotional expenses, publicity, royalties, insurance premiums, research and development costs. Those are all found in the financial statement, and they could be a good indicator of whether there are unique and valuable contributions. Furthermore, the intensity of these types of activities, so how large these expenses are, for example, this could be a reflection on the intensity of the DEMPE functions and thus whether there are intangibles owned by the company. If the differences are too significant, then we discard the comparable. However, on certain occasions, it could be appropriate to adjust the deduction of these expenses to improve comparability. So why now? Well, across Latin America, we are seeing that the differences in the capacity of countries to interpret or apply transfer pricing rules vary. So, for example, we conducted a study in which we saw that 23 countries, CIAT member countries in Latin America and the Caribbean, had a variety of transfer pricing methods available, as in the 5 recommended methods that are in the OECD guidelines. However, 20 of the countries, so 87% of them, mostly often used the transactional net margin method, so the TNMM. Only 3 of the countries reported using a different method as the most popular one. So there seems to be an over-reliance on the TNMM, which could be deterred by extending the approaches for designating the most appropriate method. So using the previously mentioned proposals or approaches, this could increase certainty and the ability to know under which circumstances what method will be most appropriate. And given all of this information, once we've chosen the correct method, then the next step would be to make sure that the comparables are comparable. So one way to improve comparability could be through adjustments based on geographical location. This takes me to my next slide. So there's an interesting phenomena happening in Latin America where the majority of countries have adopted the ability to make primary adjustments, as the countries that you can see on the slide. However, in practice, this option is not being used. As for comparability adjustments, these are mostly based on financial accounting and asset differences, also, as can be seen on the slide. However, we could see that COVID causes a change here. For many countries, the risks that were present before and their intensity may not be the same as in a post-COVID era. Countries are responding differently to the level of impact that they had with COVID and to their financial needs. So this gives even more of a reason to consider potential variations in market jurisdictions and thus the need to make geographical adjustments. It's especially relevant to consider that information from developing countries can be scarce or non-existent at times. And taxpayers often resort to the use of public information from entities in foreign operating markets. So this creates a problem in comparability, as the rates of development between the two markets does affect the business and financial situation of the companies being selected as comparables. The comparability adjustments are needed to eliminate this difference. This difference can be referred to as the country risk, and it can be defined as the risk induced by the location of a business activity instead of the fundamental nature of it. The risk may derive from political or economic circumstances, to give 2 examples. The country risk spread is the difference in the rate of return between capital invested domestically and capital invested abroad. So realizing that a country risk adjustment is needed is a way to eliminate this spread and make the comparability better. Now, for tested parties in a developing country versus a developed country, in practice, what this might result in is an increase to the profits of comparable entities, as we'll see in the next slide. So one way to realize this adjustment would be the location adjustment, or geographical market adjustment, would be by using macroeconomic or financial indicators that reflect the differences in the profitability of the two capital markets being compared. So the profitability between the economy of the tested party and the economy of where the comparable operates. For example, if the country risk in country A is higher than in country B, then it is necessary to adjust for this difference. This adjustment would be done by increasing the operating profit of company B to reflect the additional return on operating expenses that is in accordance with the lower country risk. The average long-term government bond yield would be used as a proxy for the specific country risk premium. In this slide, we see another example. If in the country of the tested party, the average long-term government bond yield is, say, 9%, and in the country where the comparable is located, it's 5%, then the yield gap, or the country risk spread, would be 4%. So the adjustment is calculated as follows. You take the operating profit, the operating assets of the comparable, times the country risk premium, so the 4%, and that would equal the adjustment on the operating profits of the comparable. Next, we have another way to meet the objectives that Gonzalo mentioned, which would be referential profit margin. Gonzalo, would you like to take this?
Thanks, Anarela. Well, this topic has a strong link with the previous proposals, identification of the best method rules and geographical market adjustments. And with the research and risk assessment process. So it's a very important topic and a very relevant proposal in crisis time. But it is not easy to implement this recommendation because it's necessary to put more specific weight in planning than in control. It is recommended for countries that prefer to trust in risk assessment or to adopt a risk-based approach than to increase voluntary compliance than to use resources to audit taxpayers. So it's the new approach or the trend in tax administrations. At first sight, when we hear about referential profit margins, comes mind safe harbors and their potential risk and benefits. There is people who love safe harbors, others hate safe harbors. The risks are, for example, could not comply the arm's length principle, could not be fair according to the design for all taxpayers, could be a preferential regimes if the margins are lower than the market margins, or could generate double taxation because safe harbor not always comply with the general principle, arm's length principle. The benefits: simplification, certainty, in some cases, and depending on the design of the safe harbor, more collection and voluntary compliance. But this proposal is not exactly a safe harbor. The referential profit margin is an input to develop different strategies. There is not so much experience in developing countries in the implementation of referential profit margins. But how to set referential profit margins? I repeat, it is not easy, it's not simple. Nothing in taxation is simple. Nothing in transfer pricing is simple. But it will depend on different resources. Availability of information from internal or external sources is very important. So it's necessary to evaluate the availability of the information. It's necessary to have enough knowledge on the business or economic sector for which we would like to apply referential or calculate referential profit margins. It is necessary to have a strategy. For example, if we decide in the tax administration to calculate the referential profit margins and to design a strategy, it will be for low-risk taxpayers or high-risk taxpayers, depending on the tax administration. For example, if there are a lot of low-risk taxpayers and there is not capacity to administer them, could be a good idea to calculate the referential profit margin for low-risk taxpayers. If high-risk taxpayers deserve more resources, but we don't have the resources to audit them, could be a good idea to calculate referential profit margins for high-risk taxpayers to manage them in a simplified way. In all cases, it's better to adopt a complex planning job than to carry on complex audits case by case, because we have to repeat the job several times instead of having one effort with multiple effects. First, what we have to do? To build capacity to develop studies and to monitor business. How? Again, information availability. Which information we have? For example, there is information that is basic information, but is key, or perhaps the main rock to start this work. Taxpayer register is very important because in the taxpayer register, there is the activity classification. And you know, those who work with multinational enterprises in tax administration or private sector knows that it is not easy to classify multinational enterprises in activities. This is very important because we will calculate a referential profit margin for an economic sector. And if we don't have companies that work in effect in the same economic sector, it will be very difficult to obtain a margin that fits to what we think is the sector. So to classify the activity is key. Then it's necessary to calculate, to evaluate, and to set the referential profit margin for different kind of taxpayers. Again, high risk, low risk, depending on the strategy. The second step is to develop indicators to calculate tax gap or potential base erosion and profit shifting effects. For example, a ratio could be direct taxes over the entity's income. We can compare this information or this ratio of an unrelated entity in the same economic or industrial sector. It is important to choose an entity without a significant amount of intercompany transactions. It will help to avoid biased results. Also, we have to calculate different level of profitability that can be also considered. For example, operational and gross level, to analyze the tax and financial performance of the taxpayer belonging to each sector and thus detect with greater accuracy the possible cause of the preliminary tax gap. What is a preliminary tax gap? It's the difference between the profit ratio of the taxpayer or the specific sector and the referential profit margin. We can go to the next slide. Information for this analysis has to be obtained from different sources: databases, domestic or internal databases, research, external databases, contact with the taxpayer or business associations, international cooperation, as I comment you, through a simultaneous tax audit to identify risk, through the country-by-country report, exchange of information on request, automatic exchange of information, etc. But it will be necessary to separate routine entities from non-routinary entities, as Anarela mentioned in the previous recommendation on the best methods rule. It is complex, it's not easy also, but it is possible if we look at the intensity of operational expenses. For example, for that, we have to check the intensity of expenses such as advertising, marketing, publicity, research, development, royalties. In case of intangibles, for example, we can consider DEMPE, development, enhancement, maintenance, protection, and exploitation. It would let us to know what are complex activities and then to identify them for the specific sectors. The second step is to divide routine entities from non-routine entities, considering, for example, for routine entities, the benchmark to the average of the industrial ratios, taking into account databases of the tax administration, databases of business that publish their information, whether or not the information is listed in the stock exchange. And for non-routinary entities, will be advisable to benchmark or to do a benchmark considering the consolidated financial statements on their own multinational enterprises group. The documentation or the information considered as a base could be the country-by-country report. In this context, the right to residual profit or loss of the group arise from the assessment between value-added functions existing between the subsidiary and consolidated group. These positions seek to use available and adequate financial information pertaining to the group business reality as a whole, and it is specific in their specific context. This approach would also be useful for complex business that cannot be classified in a single industry. We can go to the next slide. Why no? Because it is necessary to simplify and to obtain collection increases time. And for that, we offer different alternatives on how to use the referential profit margin or this analysis. The first one is the traditional one. The traditional approach is set parameters or referential margins just for internal use of the tax administration to identify compliance risk and to select taxpayers to control. The second one is to disclose the result of the analysis, informing consequences and advantages of aligning the results of the company to the referential profit margin. It could generate certainty among taxpayers, voluntary compliance, and it could be useful to design cooperative compliance initiatives. Is useful information to apply general anti-avoidance rules, or to assess the information of the Action 12 of the Base Erosional Profit Shifting Plan on disclose of tax planning. So it's possible to assess the tax planning because we will have the referential profit margin. That the referential profit margin is not just one threshold or one figure. The referential profit margin is a cocktail of indicators that let us to understand a business and to delimitate different limits on what is reasonable in terms of profitability of companies. The third option is the optional safe harbor. Safe harbor, the tax administrator, the country can design a safe harbor. It could be convenient for companies, and companies opt to comply with the safe harbor. It generates certainty and voluntary compliance. Then the last option is the mandatory safe harbor, considering an opt-out measure. Mandatory safe harbor could be unfair for the taxpayer according to or depending on the design of the safe harbor. That's why an opt-out measure is very important, because if the taxpayers can demonstrate that the business doesn't fit with the criteria of the safe harbor and want to be transparent with the tax administration, could give all the information necessary to assess and to negotiate an advanced price agreement, for example. That's why we say that the calculation of the referential profit margin is a practice that at first sight it seems a safe harbor, but it's not a safe harbor, because we will consider in the analysis all the elements necessary to achieve the arm's length principle. For example, adjustments, the base of the analysis for the best method rule, and the specific characteristics of some business when the business wants to be transparent with the tax administration. It is not easy, as I commented before. I repeat that it is not easy because at the beginning we talk about simplification, but to have a simplified measure doesn't imply that the work is easy. So it's simplified for the taxpayers, not for the tax administration, because the analysis is always complex. But the idea is to motivate more voluntary compliance and less control with these strategies. Being control, the exception to the rule or the last resource. Because we have to consider that increases time, tax audits for business that are not having a good moment is not politically charismatic. We can go for the next slide. I will comment you about a recommendation. Is very important. You know that developing countries used to export commodities and raw materials. They represent, in some countries, more than 50% of the economy. From the taxation point of view, tax administrations has a great challenge at the moment to assure revenues from commodity sector, especially in this crisis time, where it is necessary to reduce the gap and to be more efficient at the moment to control very relevant actors of the economy of the country. The best method for commodities and raw materials, according to the OECD, is the cap, We agree, but those who are working with transfer pricing knows that there are complexities. For example, it's very difficult to implement comparability adjustments because there is not enough information. It's hard to evaluate the quality of the commodities because one commodity is not the same in one country than other. There are differences in the weather, difference in the land, difference in the value chain of the sector or the measures of the governments, and that make complex to calculate the cap. The good news is that the OECD, in the framework of BEPS, implementing some new elements based in the Latin American experience regarding transfer pricing and commodities. They implement two developments. One of them is the possibility to use the dim date to identify the market price of the commodity. Dim date could be, for example, the shipping date. It's not the date where the price was negotiated between parties, is the price of the shipping procedure, and at this time it is possible to take the price in the stock exchange or in the market where the commodity is negotiated. The other one is the presentation of the contract in a timely manner to let tax administration to verify what we call the certain date. Is the date of the contract that in the past, but according to the scheme discovered by countries, the date of the contract were manipulated by taxpayers to adequate the date and the prices to the period of the year where the prices were lower, and then to sell when the price were higher. So it generates low taxation, high profitability. We can go to the next slide. Thanks. So what we recommend in particular is to use cap when there is a spot market price. That's possible following the OECD recommendations, and it is not very complex when the information is available. Our proposal is to try to not to motivate the behavior of the taxpayer with that use a very known but at this moment used scam to evade and avoid taxes using commodities or raw materials. The scams is based in the what we call triangulation. Triangulation is, for example, the country A export commodities to a tax haven. In the tax haven, there is an intermediary that it's supposed that it hasn't economic substance, and the intermediary re-export to the third country, country B, where the commodity is consumed or processed. It seems easy, but I am telling you the simplified story. Sometimes there is more than one tax haven, there are more than 2 countries, but basically that's the risk. how can we identify the risk? Following different routes: the route of the documentation, the route of the money, and the route of the commodities or raw materials. Sometimes there is a mismatch between the route of the commodities or raw materials because they go directly to the consumer. The documentation, the invoice, and the contract used to go to the tax haven, and the money can go to the tax haven or to other jurisdiction. This mismatch can give us an idea of the tax evasion or possible tax evasion. What we are recommending is a specific anti-avoidance rule with the following characteristics. Next slide, please. The specific anti-avoidance rule is based on what we call SIX method, invented by Argentina to control the export of commodity. Then the SIX method was implemented by Uruguay for import and export, and Ecuador, Dominican Republic, El Salvador, and other countries. Paraguay also. Paraguay implemented the SIX method as a tax on export of commodities. But there were some mistakes in the experience. But despite the mistake, the experience was has a very high impact in the collection and in the behavior of the taxpayers. Regarding the scope, we are suggesting a measure for import and export, as 90% of the LAC countries who implemented this measure. Regarding the nature, this is perhaps the most important aspect, is not to implement this measure as a transfer pricing method, because a transfer pricing method had to comply with the arm's length principle. We don't want to comply necessarily with the arm's length principle. Our objective is to dismotivate triangulation with commodities, the bad behavior. That's why we are suggesting, not as a substitute, if not as a complementary measure with the OECD cap, the specific anti-avoidance rule. The SIX method as a transfer pricing method could generate some risk. One of them is to discuss in the court if the SIX method apply the arm's length principle. That's the problem that Argentina has with the SIX method. That's why there is one lesson learned that was considered in this recommendation. Regarding the object of the measure, we could consider raw materials, commodities, but we can consider other kind of services or products that has a behavior similar a commodity. It will depend on the country that would like to implement this recommendation. Then, regarding the criteria or the situations that motivate tax administration to apply the specific anti-avoidance rule, one of them is the relationship. When we think in transfer pricing, or to apply a transfer pricing measure, first we have to prove that exists relationship between parties, related parties. It is not easy for developing countries. Sometimes there is not availability of information to prove the relationship. And I guess that the big risk in this scheme is the price, not the relationship. It's very hard to prove the relationship between the intermediary and the company in country A, for example, or the intermediary in tax haven. It was one lesson learned of the sixth method in Latin America, that the company says, okay, it's not a related party, I can obtain the information, and the tax administration wanted to obtain the information, and it generated disputes and problems. So I recommend not to consider relationship as a criteria. Then the substance or the economic substance of the intermediary in the tax haven is another issue. It could be a good criteria, but it's hard to prove that the international intermediary in a tax haven has or doesn't have economic substance. The same reason, the local company will say, okay, I don't have access to enough information of the intermediary to prove tax administration the substance of the intermediary. In that cases, we can consider two options. One of them is to have a presumption that the intermediary doesn't have economic substance because it's situated in a tax haven. Could be unfair for some taxpayers. And the other is disregard this condition. The other conditions could be invented by countries according to the commodity, the situation, the context, the objective of the measure, but I recommend that the distortion in the price be one or the criteria, the main criteria. If we calculate a referential price for one commodity and we compare the referential price with the price of the contract or declared by the taxpayers, if there are distortions, we will have to apply the specific anti-avoidance rule. Regarding the hierarchy of in the application, it is not a method. So it's out of the analysis of the best method rule. It's a specific anti-avoidance rules. We suggest to apply the specific anti-avoidance rule if there is a risk, and the risk is the difference in prices. Adjustments, again, that's complex. Is what we need to calculate cap. We are suggesting a specific anti-avoidance rules to correct the behavior of the taxpayer and not to apply the cap that it could generate disputes. I don't recommend adjustment. If it is necessary to implement adjustments, I recommend to consider them to calculate the referential price according to the legislation. So the legislation has to say which kind of adjustment could be considered and which kind of adjustment can't be considered for the referential price. So the taxpayer don't have to challenge the referential price because it's from the legislation or is detailed in the legislation. Exceptions are necessary because taxpayers have their particularities, and we have to consider each case to not to be unfair and to try to achieve the arm's length principle. In that case, if a taxpayer can demonstrate to the tax administration that they have it has a particular situation that drives tax administration to analyze other approach for this taxpayer, and the taxpayer is transparent with the tax administration, we recommend the possibility to have an opt-out measure, like, for example, an advance price agreement. Next slide, please. Why now we are suggesting this measure? This measure in crisis time led us to dismotivate a bad behavior of taxpayer in a pacific environment without audits. Audits are not charismatic in crisis times because the situation of the companies is not the best in most economic sectors. It has a temporarily effect because it is hard to think that taxpayers won't have in the future new scams to try to reduce the tax burden using in commodities or raw materials, export, using other scams, but at least we will have one less problem. The idea of this measure is not to solve the problems with commodities, it's to solve one important and relevant problem with commodities. To improve transparency, because referential prices can be public for taxpayers, and they will have certainty that if there are distortion between their prices and the referential prices, there will be consequences, the application of the specific anti-avoidance rule. It's also good for tax administrations that can destinate their resources to other risks and not to these risks, because when there is a solution for one risk, there is availability of resources to other complex cases that require audit, or perhaps to use the resources to the risk assessment system or planning to avoid, to try to calculate more indicators to generate certainty and a similar effect regarding different international taxation risk and in particular transfer pricing risks. Other important topic is the additional revenues we can the tax administration could receive as a consequence of the application of the specific anti-avoidance rule and the change in the behavior of the taxpayer. And we know that it is in crisis time, it's better to reduce the tax gap than to increase existing taxes or to create new taxes for those who always pay or comply with the tax system. I recommend you to evaluate your commodities and relevant business to identify when or in which situations this recommendation could be useful. Well, this is a very important area because the developing countries are far away to apply risk assessment models. What we recommend from CIAT is a centralized risk assessment system, but it doesn't exist in almost all tax administrations. Tax administrations assess risk, obviously, it is necessary, but not in a centralized way and not with systems that communicate each other. There are systems for small and medium enterprises, some systems for multinational enterprises, some systems for specific sectors of the economy or segment of taxpayers, but there is not a centralized model that let tax administration to act in an intelligent way. It is very important to consider to systematize the risk assessment process, because it brings a lot of advantages. One of them is to reduce control time. The other is to have more certainty at the moment to select taxpayers to be audited. The other is the possibility to analyze what is happening in fact, to develop strategies and to assign to different taxpayers treatments according to their behavior. For example, we could consider a cooperative compliance initiative for low-risk taxpayers, or the application of the specific anti-avoidance rules for those who has a specific risk we can detect with the risk assessment model. It is very important, and in my opinion, the base of the recommendations we give before. Without a good risk assessment model, it's not possible to achieve or to front the challenges that the current crisis impose to tax administrations. I guess that in crisis time, we need to increase efficiency of the tax administration. The only way to increase efficiency when the resources are low is to trust in the planification, and risk assessment is planification. Again, it is not simple, but it's convenient. We can go to the next slide. We need to have availability, or the information available, because information is the first step when we talk about risk assessment. If there is not information, it will be hard to formulate indicators that give us good information to identify which taxpayer have high risk, mid risk, low risk, or potential risks. I guess that is the first step. It will take time for some developing countries, because to access to the information or to make information available, sometimes are necessary reforms or legislation reforms. It is not easy in all countries, in every country, and it takes time. But I guess that this is the moment to suggest reforms, to generate systems that be used when the economy start a recovery stage. In the recovery stage, there will be more tax base, and we will have to tax the new tax base after the crisis. This is the moment to planify, to identify information sources, to suggest emergency legislations to protect the revenues or the tax revenues necessary to pay the international loans that countries are having now as a consequence of the crisis. Let's go to the next slide. This is the roadmap of the risk management, transfer pricing, and international taxation. In the previous slide, I talked about risk assessment in general, or the importance of risk assessment in general for tax administrations. And what we recommend is a centralized risk assessment system. But we consider that for transfer pricing, it is necessary a subsystem that be connected with the centralized system to identify the specific risk of transfer pricing. Because the general system is not useful for all purposes. And in transfer pricing, the experience of the tax auditor or tax investigator is very important, because we can't systematize all the process and to obtain the result directly. There is a mix between an automatized shop and an handcraft shop. First, we have to inventory and evaluate the information availability. For example, which information we are receiving from the taxpayer: income statements, balance sheet, information from related parties, import and exportation. What the quality of the information? This is a very important topic, and we have to pay attention to the quality of the information, because we can have the best risk assessment system for transfer pricing, but if the information doesn't have the quality we need, the results won't be the expected. For example, as I commented you before, it is important to identify in which economic sector the company is working, to try to associate the company to one sector and to compare the information. It is important also to trust in information from abroad using international instruments, exchange of information, country-by-country report, and other tools that could be useful to access to information to assess transfer pricing. This is very important, and in some cases, countries have to adapt their legislation to make information available, and in some cases, when the information is available, to access to the information, because not always tax administration can access to the information existing in the country. Public information is also important. Commercial databases use public information that could bring good results when we talk about, for example, calculation of prices or referential prices of commodities or raw materials, or at the moment to calculate the referential profit margin, report from technical report from prestigious institutions on business and economic sectors are very important as an input. Not all the information we need is the information of the taxpayers. We need also information about the economic sectors to understand the value chain, to understand the context in which the companies operate, and all elements necessary to have a holistic view of the taxpayers or at the situation. The second stage is the integration of the data. First, we have an inventory of data, but it is not easy to make conclusions with the data if we don't group the data. For example, we don't want to see the picture. We prefer to see the film. That's why it is important to have multi-annual information to identify changes in the behavior of taxpayers. That's critical in this crisis, because the crisis changed the way in which companies work, change their results, change their margin, their cost. We can compare, for example, a hotel or airline now with the same company or business 10 months ago. That is necessary to monitor what is happening, to try to see what is the risk, what is the change, what was low risk in the past, what is high risk now. It is also important to centralize the information, to identify connection between different information sources, and to process the information. That's what we call intelligence. If we have information centralized, it is more easy to not to duplicate work and to try to find connection between the information to exploit 100% the information we have. in order to use the information available. The practical application of indicators, we can consider generic indicators. We need to understand the multinational enterprise before understanding transfer pricing. So that's why we split indicators between generic indicators, context, business, and transfer pricing indicators that is focused on related parties and their prices in different kinds of transactions. The fourth stage is the integral risk system. The idea is to identify the taxpayer with the highest position of international operations and with related parties, identify extraordinary operations, sales of intangible inventory, fixed assets, business change. It is important because there are just some examples, but the idea is to generate the conclusions here after the implementation of the indicators to identify the risk of different taxpayers to generate a strategy and apply to each taxpayer an adequate treatment. Then the practical application in a specific case is the implementation of the system. The implementation of the system is for example, the application of a specific anti-avoidance rule, the application of procedures to apply the best method rule, the calculation of the referential profit margins for a specific sector because it's low risk or high risk, to suggest a change in the legislation because we identified a gap in the legislation that generate avoidance, and the only way to combat the avoidance is to change the legislation. There are different treatments, but it will depend on the case, on the risk, and on the strategy of the tax administration and its resources. We can go to the next slide. Anna, the floor is yours.
Sorry, I was on silent. Thank you. All right, so I'm going to talk to you about methods for dispute resolution, specifically conclusive agreements. As we've seen in the international tax world, there seems to be a trend towards implementing alternative means of dispute resolution. The objective of these is to work out differences between the tax administration and the taxpayers in a way as to have more cooperation, transparency, increased flexibility, promptness in terms of filing, and overall the intention seems to be to help taxpayers comply with their tax obligations while achieving faster tax collection for the tax administration. In some cases. Overall, these mechanisms can result in better treatment for the taxpayers, and they've grown to be cornerstones of the tax system in the various countries where they are being used. For example, in Australia, Canada, France, India, Italy, Spain, New Zealand, the UK, the USA, and others. So what should we take into account when trying to design conclusive agreements? Well, there's different aspects. As you can see in this table, for example, we could see the consequence of the procedure. Perhaps it could be that a solution is reached in all cases, or a solution is reached only if there's an agreement. Option 2 here could be better, to only reach a solution if there's an agreement, because the taxpayer could be more motivated to partake since there's no obligation to accept a solution. As for the time period to reach a conclusion, it could be that there is like an established time period within which it must be resolved, or it could be that there's no established time period. Again, for the taxpayer, option 1 would enhance certainty, and for the tax administration as well. However, it would create an obligation for them to meet these periods. So it could be something that the tax administration would have to evaluate before implementing. As for the characteristics of the independent party who acts either as option 1, a mediator, or an arbitrator, in this case, option 1 would give more confidence because if no agreement is reached, then the taxpayer could continue to dispute by other means. The statute of limitations in this proposal, it suggests that the process of the dispute resolution shouldn't be affected by time limits that were established in domestic law without taking this into account. And as for the sanctions, if there is a reduction of sanctions, then it can motivate taxpayers to apply for the procedure. So we're going to look at one practical example, which is the experience in Mexico. So we have the Office for the Defense of Taxpayers, which is also known as the PRODECON. This process is a conclusive agreement, and it has the PRODECON acting as a facilitator or a witness to the process between the taxpayer and the tax administration. So to give you an example of some of the characteristics, the taxpayer can apply in writing when they have been subjected to an audit and they think that there is something incorrect with the assessment or they weren't treated fairly. They can request in writing to have this procedure with the PRODECON started. This request must be submitted before the notification of any unpaid taxes due. That's an important point. Then there is reconciliation process between the taxpayer and the tax authority with the PRODECON, the Office for the Defense of Taxpayers, acting as an intermediary to facilitate communication, help work towards consensus, and attesting that the agreement follows the tax rules and respects the taxpayer's rights. If the agreement is reached, then it must be signed by the taxpayer, the tax authority, and the PRODECON. Once it is signed, it does not constitute a legal precedent. It will not be possible to challenge. The conclusions reached are binding, and not even under MAP can this agreement be challenged. So the impossibility for recourse is, in the perspective of the tax authority, a feature that facilitates its conclusion, and this is known, expressly stated in the Mexican laws for taxpayers before they start this agreement, or before they sign. Overall, it seems the results have been successful. There's been approximately 2,000 conclusive agreements signed since the inception of the program from 2014 until mid-2017, so about 3.5 years. And that's it for our presentation. In conclusion, we'd just like to say the above mentioned ideas could potentially help to assist with the easier application of transfer pricing rules, to provide guidance on control mechanisms, dispute resolutions, and this could be helpful in times, especially in times of crisis. So there is a difference between I'd like to point out that there is a difference between simply meeting the requirement for applying the transfer pricing guidelines versus doing so in a way as to really sustain the arm's length price. If you would like to know more about any of the topics that we've talked about, please visit the CIAT website and download a copy of the cocktail for measures to control abusive transfer pricing manipulation, which contains these and other suggestions. Now we can move on to the question and answer part of the webinar. Thank you very much.